Hey everybody, Marty Missouri here. It's Friday, the 22nd of September, 2023, with your weekly economic update. This one I think I can just run through really quickly. Nothing's changed in terms of our net score. We did have one component deteriorate. We actually had one get better. Both came from the neutral column, one into negative, one into positive. So at the end of the day, we end up with the same score, which is just that little flat line right there. Still down 25 points, negative 25 points, which says conditions favor recession over the next few months versus ongoing expansion. I always choose a handful of our inputs to take a peek at. We'll start with housing starts that came out this week. They actually dropped quite a bit, so not a good look there. While there was indeed a decline in single-family starts, the bulk of that decline was in multifamily starts. And we know a tremendous amount of multifamily/rental supply came on market since COVID, and clearly that's now beginning to slow down. In terms of permits, though, which of course precede starts, actually rose a bit. And they did show up once again for multiple months in a row in the single family space. So still looks like there's new homes to be built. We've talked a lot about housing the last few weeks and months. Existing home sales just really aren't there. There's very little inventory. Folks have locked in 3% mortgages. They're not going to give those up. So builders have had a pretty good go of it of late. And KB Homes announced this week, and they actually had a pretty good earnings report, but their forward outlook, is beginning to be suspect. And we're seeing that in homebuilder sentiment, officially known as the housing index. This last month actually dropped to 45. Now below 50 denotes contractionary conditions. So homebuilders aren't feeling so great, and they're really seeing it in foot traffic. Scores a 30, which is way below 50. So home builders clearly have some concerns, which really comports with our overall economic thesis. Now, what doesn't comport with our thesis is jobless claims. They are dropping. 201 this last week. That really surprised everybody. Continuing claims down as well. It is still a pretty tight labor market. Now, historically, as I've illustrated here and on the on the monthly jobs numbers, it is typically not long after those things begin to go south, or in this case, jobless claims begin to rise a bunch, is when you get a recession. So this is encouraging. It's not encouraging if anybody wants the Fed to back off anytime soon. This actually supports Jerome Powell's commentary here this week that inflation is still a real challenge, that they may need to raise rates one more time this year, and that their expectation for interest rates next year are higher than what they thought as recently as a couple of months ago. Another important input is the Cass freight data that came out this week as well. You can see a little bit of improvement here in shipments. Expenditures actually rose a little bit. We subscribe to the work of economist Peter Bookfar, and he does a nice summation of weekly data every Friday. So often I'll leverage his commentary when he features things that we feature in our index. And his comments from this week's Cass report are as follows. Cass Freight said its August shipment index rose 0.8%, seasonally adjusted, but are still down 10.6% year over year. They said, quote, the freight market down cycle is now 20 months old, which compares to a range of 21 to 28 months in the past 3 down cycles, for what that's worth. Wanted to point to copper because it's rolling back over again. It has continued to kind of do battle with its 50-day moving average. You can see it still looks like, it's kind of in a consolidation phase in here. You could say this looks like a falling wedge pattern, which is ultimately a bullish pattern. So we'll see if we break out higher. Honestly, it won't surprise me because of the correlation to the Chinese economy. The latest data from China says that maybe their woes are beginning to bottom. We do know that they've been incrementally throwing stimulus at it. Last night, Chinese stocks had a really nice rally. We're not bearish Chinese stocks going forward, but we're not necessarily bulls on the long-term trajectory of the Chinese economy. But the powers that be do need to probably continue to step in with stimulus and to support their property market. And as they do, if the world buys it, you'll probably see copper do relatively well. And of course, it all depends on the type of stimulus that they do. Beyond China and copper's correlation to China, copper rolling over is consistent with our go-forward economic thesis. Over the years, copper has supposedly earned the nickname Dr. Copper, as in it has a PhD in economics. So a lot of people think follow copper and you follow the economy because of its ubiquity in terms of its industrial use. And in our equity market conditions index that we score monthly, along with our own macro index, we do use the copper gold ratio. It's been a pretty good indicator of the state of the economy, and right now doesn't paint a real robust picture about, again, economic state of affairs presently. Now, what was a positive was the Baltic Dry Index. The Baltic Dry Index tracks the shipment of goods across the world's oceans, and typically it rises and falls with the state of the global economy. Now, other factors like supply of ships and other dynamics play into that as well. But we have seen it come pretty strongly off the bottom, and over the last week or so, it's had a pretty good pop, which says something, on balance, positive about the state of the global economy. The consumer staples to consumer discretionary equity ratio has had quite the rally here of late, just in the very short run. As you can see on the year, it's way down. But we do track this as a market-based sentiment indicator about the state of the economy. When this is going up, that suggests that folks are beginning to rotate money into the companies that provide the things that are staple, the things that we need to buy if we want to keep living, as opposed to discretionary items, the things we buy when the economy is strong and we have extra money. So keep an eye on this. Still down dramatically from the beginning of the year, but this didn't change score for us, but it was worth noting that we've seen a little pop in that particular ratio here of late. And then lastly, for our inputs, the leading economic indicators came out. You can see right there, there's just a little straight line. That's this month, so that didn't change. It stayed the same. As I've pointed out, we're at levels we've never been without being either in recession or in very close proximity to recession. And this is a very telling, very accurate indicator. So again, if we get through this and we do this immaculate soft landing, well, then this will be a first. And I'm open to it for sure, but right now it says be on guard and have a defensive flavor to some degree, at least, in your portfolio. And then lastly, I wanted to pull in the dollar. Remember, we had this rising wedge pattern, so we went neutral on the dollar. We were bullish on the dollar in our August report, and that turned out to be right on the money. We could go either way. I said, we'll just go neutral. We won't be bearish, we won't be bullish, but we did have somewhat of a bearish pattern, and we did break down below that. But here recently, the dollar has gained strength again, and it probably has not small degree to do with the Fed coming in pretty hawkish. So right now the dollar has been getting some support. That might have as much to do with the copper decline here of late as anything else, and it certainly isn't helping the stock market right here. But it's just another wedge pattern. We still don't really have much bullishness here on momentum, and we're almost overbought. So it'll be very interesting to see how this continues to play out, but it's definitely a weight on asset prices based on how correlations work out here of late. A lot of mixed signals. I've shown you a few positive things in this week's report. On balance, the scales tilt negatively in terms of economic prospects going forward, and that's a negative picture for asset prices, at least for the time being. I'll say it for the umpteenth time. Once we get through whatever's left, we think there's a strong long-term investable thesis in what are kind of new dynamics, at least relative to what we've experienced the last few decades. So much more on that in the weeks and months to come. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Talk to you next week. Bye-bye.